You look at the price of silver. It reads above $80 per ounce, maybe higher. The number looks real. It feels real. So you pick up the phone and call your local coin dealer. Sorry, we're not buying right now. You try a refinery. We've paused purchases. You go online to a wholesaler. We'll get back to you on pricing. The number on your screen hasn't moved, but the market, the real physical market where actual metal changes hands, has quietly frozen. This is the reality of 2026. Most people are watching numbers move on a screen, completely unaware that the floor has already collapsed beneath the paper system. Today, we aren't just looking at prices, we are looking at the death of an illusion. And once you understand what is actually happening, not in the futures markets, not on a Bloomberg terminal, but in the vaults, the refineries, and the supply chains, you will never look at a silver price chart the same way again. Here is the first truth most financial media will not tell you. There are not one silver market. There are two. And right now, they are living in completely different realities. The paper market sits in New York and London. It trades billions of dollars of silver every single day. Prices update by the second. It looks liquid, orderly, professional. The physical market is where you actually get the metal. Coin dealers, refineries, industrial buyers, sovereign mints. Right now, refiners have pulled out, wholesalers are refusing to pay up front, and coin shops are offering $10 to $15 below spot. Dealers are simultaneously pushing fear-based narratives about shortages while bidding well under spot for silver rounds. House of Commons Library. Imagine the desperation of a mint that cannot find raw metal to process. Imagine a collector who has been holding silver for years, calls to sell, and is told, "We are not buying today." The price on the screen says one thing. The real world says another. That gap, between what paper promises and what physical reality delivers, is the story of 2026. Now I need you to stop. Listen to this number carefully. 356 to 1. For decades, global silver price discovery was firmly controlled by futures traders on COMEX and LBMA. The notional ratio reached as high as 356 to 1. In other words, the amount of silver promised on paper far exceeded the metal that could ever physically be delivered. This system did not collapse for one simple reason: nobody asked for delivery all at once. Council on Foreign Relations. Lean into that for a moment. For every single physical ounce of silver that exists in deliverable form, 356 paper contracts are claiming to own it. Ask yourself this. If you were a bank with only 1 ounce of silver, but 356 promises to pay it out, what would you do when clients come knocking at the same time? You already know the answer. And in early 2026, that theoretical question became a real one. In just 7 days, between early and mid-January, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. Council on Foreign Relations. The music stopped, and there were not enough chairs. This is not speculation. This is COMEX's own warehouse data. As of February 5, 2026, March 2026, open interest stood at 429 million ounces. COMEX registered silver inventory, the metal actually available for delivery, stood at 103.5 million ounces and falling. The inventory drainage rate had accelerated to 785,000 ounces per day. NPR. Do that math. January 2026 deliveries hit 49.4 million ounces, 7.27 times the level of January 2024. NPR, not 7% higher, not double, 7.27 times. Since 2020, COMEX registered silver inventory, the metal immediately eligible for delivery, has shrunk by roughly 75%, currently hovering around 82 million ounces. At the same time, open interest in the March 2026 contract remains between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 to 455 million ounces. Al Jazeera silver is in backwardation. facing high demand, record prices, and metal leaving the vault at a rapid clip. Wikipedia. In commodity markets, backwardation is one of the most powerful signals of acute physical shortage. It means buyers are willing to pay more for silver right now than for silver delivered in the future, because they are not confident it will be available later. The Chicago Mercantile Exchange itself cited technical issues just ahead of First Notice Day, the day when paper contracts can stand for physical delivery. There were no major outages reported in the 5 years prior, until November 2025, when silver was pushing all-time highs, also right before First Notice Day. The pattern is difficult to ignore. Wikipedia. This freeze did not happen overnight. 4 structural forces have been building simultaneously, and 2026 is where they all converged. Wall 1, 6 consecutive years of supply deficit. Even with higher supply, the global market stayed in deficit for the 6th straight year. The Silver Institute forecasts a 67 million ounce deficit in 2026. As a result, the market relies on stored silver reserves, adding enormous pressure to an already tight supply. NPR. Global silver inventories in LBMA and COMEX vaults have been depleted to levels not seen in over 2 decades, leaving very little buffer to absorb sudden demand spikes. Yahoo Finance Wall 2. China erects the silver curtain. On January 1, 2026, China changed everything. By restricting exports, China is effectively saying the rest of the world can no longer rely on Chinese refined silver to plug its deficits. From 2026 onward, the structural shortages that were previously papered over by drawing down above-ground inventories are evolving into an overt supply crisis that can no longer be masked. Council on Foreign Relations. Even China's tightening of silver export licenses from January 2026 is squeezing global physical supply further, reinforcing scarcity. CNBC China has designated silver a strategic asset. When a government reclassifies a metal as strategic, they are not doing it because supply is abundant. Wall 3. The machines are hungry. Industrial demand that cannot stop. Here is what makes this crisis unlike any previous precious metals squeeze. Sectors such as solar energy, automotive electric vehicles, and data centers and artificial intelligence will drive industrial demand higher through 2030, according to the Silver Institute. CNBC data center silver demand is surging. The US and China alone consumed an estimated 350 million ounces in 2025, exceeding 50% of mining supply. CNBC. While speculative fervor cooled following the late January flash crash, the underlying industrial fundamentals have never been stronger. Solar and electronics manufacturers are scrambling to secure long-term contracts for the metal. Yahoo Finance. The AI revolution runs on silver. The green energy transition runs on silver. Electric vehicles run on silver. These are not trends that pause because a futures contract got margin called. Wall 4. The paper crash that changed nothing fundamental. Silver saw a record intraday drop of over $47 from $121 to $74 before recovering. Margin selling was triggered by CME's shift from fixed dollar to percentage-based margin requirements. House of Commons Library. But here is what the mainstream narrative missed entirely. While short-term pullbacks were expected as the paper market deleveraged, the fundamental backdrop remains defined by a 6th consecutive year of supply deficits and insatiable demand from the AI and solar sectors. Axios. The paper price crashed. The physical shortage did not. Those are 2 completely different things. We are now at the most important part of this story. Price volatility itself is evidence of systemic fragility. The parabolic surge toward $121 was driven by short covering and a short squeeze amid severely depleted liquidity. The subsequent collapse did not stem from large-scale physical selling. It came from CME's forced margin hikes, which compelled leveraged participants to liquidate en masse. Al Jazeera. Nothing about physical silver changed. The metal in your hand did not become less scarce. The AI data centers did not cancel their orders. The solar farms did not stop being built. The COMEX simply forced paper holders to sell paper. Solar and EV manufacturers who stepped back when silver hit $120 have reportedly returned as aggressive buyers in the $80 range. Axios industrial users, the ones who actually need the physical metal to build things, used the paper crash as a buying opportunity. That is the bifurcation. Paper holders panicked. Physical buyers loaded up. The physical market is tightening. The East is gaining price power. Institutions are accumulating. When price control mechanisms start glitching during delivery windows, smart money pays attention. Wikipedia. This is where the narrative changes completely. Most people think of buying silver as a hedge against inflation. A defensive move, a fear-based decision. Something goes wrong, so I buy silver. That framing is outdated, and it undersells what physical silver actually represents in 2026. When you hold physical silver today, you are not just holding a hedge, you are holding a triple identity asset. Identity 1, industrial. For AI, EVs, solar, and advanced electronics, silver and gold are no longer just commodities. They are critical inputs whose availability shapes the future of technology itself. Industrial users cannot simply delay production when silver-rich solders or contacts are unavailable. The cost of not obtaining the metal is non-production, seeking alpha. You are holding the fuel of the AI revolution. Identity 2, monetary. For 5,000 years, silver has been money. Every fiat currency in history has eventually failed. Silver has outlasted every single one of them. Emerging market central banks are accumulating silver as a monetary and strategic asset. Council on Foreign Relations Russia moved first. Others are following. You are holding the only currency that has survived every collapse in recorded history. Identity 3, strategic. The United States has added silver to its critical minerals list. China has classified it a strategic material. The U.S. launched Project Vault to stockpile critical minerals. You don't take such steps when silver is abundant. Al Jazeera governments are competing for this metal. You are holding a geopolitical asset. This is not a fear trade. This is a conviction trade. You are not buying silver because the world is ending. You are buying it because the world is changing, and silver sits at the center of that change. The institutions are not panicking, they are positioning. Many are converting paper ETF holdings into allocated physical positions, securing delivery before liquidity disappears. Others are building private inventory reserves, anticipating prolonged export restrictions and logistical bottlenecks. Council on Foreign Relations. They understand something that most retail investors have not yet grasped. Physically held silver outside the system is becoming the only reliable store of value. The next upward leg may not be fueled by optimism, but by the sheer necessity of buying. Al Jazeera. The paper price can be manipulated by margin hikes. Physical supply cannot be printed. The question for you is no longer, where is the price going? The question is, what do you actually own when the screen goes dark? Do you own a number on a brokerage statement, a paper promise backed by 355 other competing claims? Or do you own something real, something with weight, with history, with 3 independent reasons to be valuable in the world that is being built right now? You don't need COMEX to collapse for gold and silver to surge. You just need trust in paper markets to weaken. And trust is already fraying. Wikipedia. The refineries have paused, the vaults are draining, the institutions are converting, the paper system is showing its cracks. The smartest move has never been to react to the crisis after it arrives. It has always been to own the reality before the illusion breaks. Stay informed, stay positioned, own the reality, not the promise.